So guys, we asked you to ask us any questions that were coming up for you about trading on our social media, and we've had an awesome response. We've picked out the 20 top questions that we want to answer for you, that we think are going to serve you on your journey best. So I'm going to answer those questions for you now. Okay, so question number one, and the question is this: what are the best trading hours? Where do you live in the world? That's got to be a starting point, okay? We live in Mauritius, so we don't want to work all night. I have a family, you've got to look at life balance, you've got to look at all those aspects, whether you're in a job, whether you're self-employed, what time is available to you. So it's not simply a question of what are the best trading hours. There are times of the day where you could pick volatile market times that are going to give you opportunities. So like European opening, New York opening, Hong Kong opening, okay? So there's always volatility around the openings and the closings of those markets. Does that suit you? Well, that's a question only you can answer. The factors that you need to take into account are, like I said, your lifestyle. How much time do you want to give to trading? Are you in a job? Are you self-employed? Are you unemployed? Can you give all day to it? We trade 9 a.m. to 5 p.m. on a daily basis, okay? Because that's a working day here, and I have a trading team that facilitate that. Now, what we might do is we might look at a shift pattern so that we're covering all of the hours that are available to us, because there are opportunities. So 5 p.m. through till 1 o'clock in the morning, say, 8 hours, and then another 8 hours, 1 a.m. through till 9 a.m. That's something we're looking at for next year, but of course we've got to find the traders, we've got to train them, we've got to make sure that those time frames are delivering to us, okay? Making sure that there's profit to be taken out of the market. So trading hours, it's got to be down to you, you've got to answer those questions. I make sure that I am available at 11 a.m. Mauritian time, because that is the opening of the UK and European markets, and I always make sure that we're around about that time to make sure that I'm supporting the traders and we're making the most of those opportunities that come out of it. That's our choice, that suits what we do and how we work. So look at your lifestyle, look at what time you've got available, look at what your aims are with your trading. If you want to make it a full-time thing, then you've got to carve that out of your day. If you just want to use a value cost averaging strategy, then you can do that 10 minutes in a day. It's down to you. It's your trading plan that's going to dictate that to you. Okay, question number two. I'm going to answer this in a very succinct way, and in the way that only I know how. Okay, the question is this: how important is a stop loss? It's freaking everything, okay? Do not trade without one. If you haven't got a stop loss in place, you're committing account suicide, potentially. So don't do it, okay? It's the one golden rule. Always use a stop loss. Okay, question number three. How do I keep from selling a position too soon? Okay? It's a good question. It's a really good question. And the answer is by taking the emotions out of it, by taking the thought process out of it. So this is what we do. We have a risk management strategy. So if we enter a trade here, and we have a stop loss here, okay, however many pips that is, and let's say for argument's sake it's 25 pips, okay, then what we'll do is we will have different points, and we will put them on our chart so that we don't have to think about it, we don't have to work it out, we just watch the chart. So we will mark on our chart a line which represents a 0.5% profit, 1% profit, and I'll explain why in a moment, 2% profit, 2.5% profit, and ultimately our profit target of 3%. So how do I know not to get out of a trade too soon? Well, we're aiming to make 3%. So what we'll do is we'll enter the trade. When the trade has gone up and it makes 2% for us, we will then move our stop loss to break even. We physically enter on the order ticket, we amend it to move our stop loss to break even. That means now we have a free trade. Then as it pushes up, listen, it's not a straight line like this, okay? Trades go like this, you all understand that, yeah? Okay? So as it pushes up to 2.5%, we'll then move our stop loss. Remember, we've moved it from its stop loss position to our entry. We're now going to move it to 0.5%. We're starting to time in profit. For me, there's nothing worse than reaching 2.5% and it retracing and not making any profit at all. Even worse, retracing and making a loss. That's a crime in my opinion. So then we push on, we make 3% when we are out of the trade. So having a trade management strategy that's very clear, that is on your charts, that you don't have to think about, you just have to react to, is the best way of maximising your profits. So what a great question this. Sometimes there's massive market volatility. What do you do on those occasions? So, for me it's very simple. We just choose to step back. And that can come from two things, okay? So volatility that we see that we know is coming up. So for example, a couple of years ago when the Brexit vote was in the UK, we stayed out of the market. Who knew which way that was going to go? If we did, listen, we'd be making a ridiculous amount of money. We'd be breaking the market, okay? We'd be doing it for George Soros, right? So when we know that there's going to be massive volatility, we'll stay out of the market. Equally, when we see that our trade tools aren't delivering what we want, potentially because of that volatility, we'll choose to step back. Okay, so it's a conscious decision from us, and those are the two situations where we just stay out of the market. Okay, so physically step back, because that's what we do. Literally, arm's length, stay out of the market, watch it, monitor the trades, and then get back in when we can see that the volatility has subsided. Okay, question number 5. What is the biggest mistake that I see traders make? That's a good question. But for me, it's not just one thing, but it was all around the same thing. I see traders rushing into trades. I see traders chasing losses, okay? Rather than just trusting the system and letting it work out, grind through the trades. You're going to get losses. You've just got to respond to that in the appropriate way. So don't rush into trades. And how I sort of traded over the years is like this. We have a setup. I sit back and I ask myself, well, what is the reason not to take this trade? Okay, economic data coming out. That's an obvious one. Do I like the look of the chart? Even down to that feeling of intuition. I just don't want to take this trade. I don't know why not, but there's something about it that I can't put my finger on. Listen, if I have that element of doubt, I stay out of the market. It's as simple as that. Make sure you're picking the best trades you can, and don't rush into trades. Less is more, in my experience. And what I've seen over the years is that our average number of trades has come down from 9 to 4.3. Okay? That's the average number of trades we're in at any one time. Don't overtrade, don't rush into trades. Next, question number 6. What is the difference between Forex trading and commodity trading? It's a different animal. One is currency, one is gold or silver or platinum or oil. At the end of the day, we are technical traders and we're trading on what the chart tells us. Okay? So for me, it doesn't really matter whether we're trading a commodity or whether we're trading foreign exchange. We employ exactly the same strategies to do that. So don't worry about what it is. The only thing you need to worry about is, have you back tested it? Is it giving you the profits you want? Does it work on that particular commodity or that particular Forex pair? So don't differentiate between the two. I quite like trading gold. It's something I've tracked over the years. So pick something that you are familiar with, that you're happy with, that you resonate with, and that's my best advice when picking commodities. The Forex pairs, we'll give you those pairs that we trade, 13 of them. I gave you that in a video a couple of days ago. Maybe guys, you can insert the link for that as well so you can check out the pairs. But there's no difference, in my opinion, of trading commodities and Forex. Question 7. When is the Forex market open? Listen, it's almost 24/7. So for us, it opens very, very late Sunday night. We're in Mauritian time here, okay? So early hours actually of Monday morning. and then runs through all the way through to very early hours on Saturday morning. There's a 24-hour period where it's closed over the weekend, Saturday and Sunday. The markets are still trading in the background, but in terms of what's available to us, the markets are closed. So other than that, there's a very small window where they're closed every evening for 10 to 15 minutes, whilst the markets transition between European and Asian and US open and closing. But other than that, it's open 24/7. So wherever you are in the world, the Forex markets are going to give you an opportunity to trade on a daily basis with a little bit of time off at the weekend, if that makes sense. So, question A, what does it mean to have a long or short position? Which is better? Whichever one's going to give you the profits, you know? A lot of people say to me, they look at my charts and they can see a downtrend, and people that aren't traders look at it, oh, I don't like the look of that. Because it's going down, okay? People associate pricing going down with losses. But the reality is you can trade both long and short, and we do both. And we like to have a mixed bag of positions so that we're hedging. We're not relying, particularly when we're trading stocks, okay? We don't want to be just in long positions or just in short positions. And that's key for us when we're trading stocks. Foreign exchange, listen, it is what it is, okay? You take the opportunities as they come. Sometimes we're in more long than we are in short, but it matters not. A long and a short position are equally good, equally capable of making you a 3% profit on a 1% risk. So don't differentiate between the two. Don't let that psychology of a down market feel like it's losing money, and it's not. That's a very, very naive, non-trader viewpoint. So, question number 9. How do I think Brexit will impact the markets? Brexit is already impacting the markets. You know, I moved here in 2016, and a few months after we did, we lost 20% on our GBP currency. Most of our money's in GBP and US dollar, so that impacted us massively. Not in terms of trading, I'm talking about my personal finance, my personal money. So it's affecting us personally. It's definitely affecting us in terms of our market strategy. Yesterday was a prime example of that. We took a long GBP US dollar cable position, and it was the perfect setup. There was nothing I could pick out that was wrong with it, but it was a losing trade for us. And I can only put it down to ongoing Brexit negotiations. So, relatively speaking, we are very, very select now about which pound-based and euro-based currencies we trade, and the times it's getting hotter and hotter and hotter as we move towards the Brexit deadlines. Just be cautious out there. It is definitely affecting the market, and I can't call it either way, okay? It's just, it's up, it's down, and I would just stay out of the markets. Brexit it's horrible. I think that it's such a big jigsaw to try and put together that nobody can really pick the bones out of it and give us a prediction either way, whether we're going to have an agreement or not, whether that agreement's going to be good for us or not. Wait and see, that's what I say, and just pick the best positions you can. Number 10, will you make any adjustments to your strategy because of Brexit? Look, yes, like I just said in the previous answer, we're going to be very selective, and we're going to stay out of the markets where it's obviously volatile and nearing key deadlines. So there's a deadline coming up in October, there's another one in November, there's another one in December, and of course we should be out of the EU by, I think it's 29th of March. So as we near those deadlines, we'll definitely be not really adjusting our strategy, but adjusting the pairs that we focus on, and obviously cable is going to be one of those pairs that we choose not to trade so much. Okay, leverage. It's a great question. Question 11. What leverage do you recommend for FX retail traders? As much as you can get. That's as simple as that from my point of view. Because that way you don't have to fund it so much, okay? This is the key with leverage. Now, when we trade on a 500 to 1 leverage. Listen, we're professional traders, we have a professional account, not everybody can get 500 to 1, but we trade on a 500 to 1 leverage, okay? What does leverage actually mean? What it means is, whatever position you buy, you're going to multiply it by your leverage. In our case, 500. I don't really think that that's what we should be focusing on. I think what we should be focusing on is this word, margin, and what it means for your account. Because regardless of the leverage, you're still going to make the same amount of money. You're just going to do it with more or less margin, okay? And that's key to me. So, for example, let's take a lower margin. Let's take a leverage. Let's take a leverage of 33 to 1. Okay? Basically, what that means is that when you place a position, you're going to need 3.3% margin to cover the position. Okay? This is your deposit. Okay? So margin is basically a deposit with the broker. So the higher your leverage, the lower your deposit. What that means in terms of your account is this. Let's say you have cash, right? Cash, physical cash, $10,000. If you've got $10,000 of cash, you could trade a much bigger account. Okay? Now, you've got to be a little careful here. You don't want to stretch it too far, but you don't need. You could trade a $20,000 account. You could trade a $30,000 account. Let's say you traded a $30,000 account, because all you need to do is cash flow the margin from your 10,000. But you could make a lot more money. Okay? Yes, your 1% loss is going to be more. Okay, so 1% of 30,000 is 300, whereas it would be 100 here, right? So you're going to lose $300, but you're going to make 900 on the upside on a 3 to 1 risk-reward ratio. So I always say to people, the greater the leverage, the lower your margin, the less you have to cash flow it. Who wants? Let's say you're trading a $100,000 account. You don't necessarily want $100,000 sitting with your broker because they're not going to pay you any interest on it. Okay? Interactive brokers say they do. It's a very complicated way of doing things. I personally don't like it. I would rather cash flow my account with less money, take that other 90,000 and put it in either an interest-bearing account or some other form of investment that I can get hold of easily. Okay? And that is how you use leverage to make sure you're maximizing your account size and making your money work for you as hard as possible. If that makes sense. If you've got more questions on that, send us an email and we'll give you some more detail. We've got a sheet that we can send out on that. So, question 12. What external factors should a trader monitor? So, we do two things. We use something called Forex factoring, and we use an economic calendar. Okay, Forex factory is one of the ones we use. We also use our broker calendar as well, so we know the timing of all of the high impact economic data that could potentially affect our trades and the market conditions. And what we do is we stay out of a trade 30 minutes before and 30 minutes after high impact economic data. So it could be a CPI report, it could be a week tomorrow, a week on Friday, the first Friday of every month, non-farm payroll. Probably the biggest monthly economic data that sways the markets, US dollar based currency pairs. So that's one thing. The second thing we do is we have the news on, either Bloomberg or CNN or Sky News, just to make sure that we are not missing anything, okay? Maybe you're trading Japanese yen pairs and all of a sudden there's an earthquake in Japan. Maybe you want to get out of those pairs, right? So we like to know what's going on globally. I want to know when Mr. Trump's going to be impeached or not, because that's going to have an impact on the market. Economic data is not, and economic calendars is not going to give us that. So we like to keep a broad view of the markets by watching the news on a daily basis. Thomson Reuters is very good for that. Those are all of the tools that we use. So that's what we keep our eye on whilst we're trading. Number 13, has an external factor ever caused me to stop trading temporarily? Yes, I alluded to it in an earlier question. Brexit. Okay, I've just talked about non-farm payroll. So on the first Friday of every month, we generally don't trade. What we try and do is minimise our losses on open positions by de-risking them or tying in profit on a profitable trade. So yeah, there's definitely times where we stay out of the market. Brexit negotiations, ongoing, deadlines coming up, those are kind of things where we'll just stay out of the market. So it's very important that you keep an eye on what's going on. We're technical traders, but you've got to have that overview of the fundamentals in the background. Question 14, is there any time of the year where you stop trading? Yep, twice a year, August and December, and both times for exactly the same reasons. August, everybody's on summer vacation, the markets are fairly illiquid, there's not much volatility because nobody's trading, so we choose to take our holidays then and stay out of the market. Early August to probably end of the first week, around about the 10th of September, same in December. We'll quit trading around about the 6th, 7th of December. We won't come back to it until 4 weeks later, till well into the new year, for the end of the first week, beginning of the second week of January, where the markets are kicked back in, everybody's back at the desk and everybody's working again. So stay out of the markets twice a year. Question 15. What is the correct way to identify support and resistance? So I'm actually not going to answer this question in its entirety here because it is a whole subject. Daily price action, support and resistance levels, supply and demand trading. We do a bit of it. We're going to grow into it as we grow our team, but I think it's such a complicated and such an extensive question. I think it's a great question. Thank you, Eliza, for posting it on social media. I'm going to record a separate video on that subject, so watch out for that coming up shortly. Question 16, how can you be sure when a trend is running out of steam? I can't. It's very simple, I just can't. If we could pick the turns every time, again, we'd be making so much money, we'd be breaking the markets, we'd be doing that George Soros when he made £1 billion on the demise of sterling. Look, if we could do that, it would be great. We do have a strategy, a pivot strategy, that does pick the turns. We're testing it at the moment. We're not comfortable, it's where we want it to be, but we're never going to be wholly accurate with that. The turns are difficult things to read. They're better on the higher time frames. You've got to look for reversal candles, dojis and hammers, engulfing candles, and you've really got to have your eye on it. You've got to be very, very thorough if you're going to try and catch the turns. So daily price action is something that we're going to talk about in its entirety. And those turns are part of all of that, so watch out for that video that I referred to in the previous question. Question 17, what are the easiest currencies to trade as a beginner? So, majors, that's the first thing, okay? Stick to the majors, don't go to the minors, and certainly don't go looking at the exotics because there's too much volatility, it's a bit random. Stick to the majors. The second thing to do is pick something that resonates with you. So whenever I start trading a new strategy, I pick two currency pairs, Euro USD and Pound Sterling USD, GBP USD, Euro USD. I pick two currencies that, I'm British, so I know about sterling. I know what's going on in my country, okay, my mother country, my motherland, right? Also keep an eye on Europe, okay? So I know those two currencies and I know them well. So that's what I do. I pick two currencies that I'm comfortable with. So if you're a beginner, pick something that you're comfortable with. I always say when I'm teaching value cost averaging, pick a stock that you resonate with, okay? Maybe you're a fan of BMW cars or you're a fan of Apple products, okay? So maybe you start trading that because you've got some affiliation to it. Same with currencies. Pick your home currency. You're going to know more about it than you are any other currency that's out there, as long as it sits within the majors. Make sense? Okay, good job guys, well done. Okay, last three questions. Number 18, how important is a trading plan? It's vital, okay? Before you even sit down at your computer to start trading, work out what your trading plan is going to be. We can help you with that, okay? And I think we should put a lesson, we should do another video on building your trading plan. Because you need to know what you want to get out of it. What are the hours you're going to be trading? What are the strategies you're going to be trading? These are all things that add to your trading plan and add to the consistency in taking out the emotions and the thought process that are going to effectively take you down. So a trading plan is vitally important. Make sure that you have one. Like I said, we can help you with that. I'm going to post something on that in a separate video, how to build your own trading plan. So linked to that, question 19, how important is trade management strategy? Well, I alluded to that in the previous question, whereby I detailed our trade management, okay? Because the question earlier was, how do I know when to come out of a trade? Well, we have a set system. Everything we do is a system. The setups are a system. Trade management is a system. I'll just run through it again. We have an entry point. We have a stop loss. And then we mark 0.5%, 1%, 2%, 2.5%, and 3%. So that when we hit 0.5%, we know where we're at. We don't have to think about it. We just look at the chart. When we hit 1, we know where we're at. When we hit 2, we'll de-risk. We have stop loss to break even. When we hit 2.5, we tie in profit, and 3% will automatically take us out of the trade. So if you want to know a little bit more detail on that, scroll back, watch the, I can't remember what number question it was, but it was very early on. Question 2 or 3 or 4, something like that. Have a look at that, and that will give you a bit more detail. So very important that you have a trade management strategy. Is there a world currency, and what is it? Look, right here, right now, everybody is still buying and trading using US dollars. It remains the world currency. China are very, very, very prominent in trying to get the yuan to be the world currency, and so are Russia. There's a lot of dirty tricks going on. For now, I don't see it changing in the next, certainly 5 years. US dollars here to stay, in my opinion. And that for me will remain the world currency. Thanks for watching this video. It's been a long one, but I think it's been important that we answer your questions. So I want to thank each and every one of you that gave us the questions. You sent some in on email, you sent some on our social media. You guys have been awesome. I hope that you've got something out of this. Please make sure that you subscribe to our YouTube channel so that you make sure you catch some of these upcoming videos with a little bit more detail about supply resistance and daily price action to help you on your trading journey. Thanks, guys.